listen-only mode.
Well, hello, good afternoon, wherever you might be. My name is Gary Munson, and I want to thank you for taking time out of your day to be on this webinar. I'm also so grateful to have Kaaren Hall, the president of UDirect, to be on here as well to share with us her expertise about utilizing self-directed IRA money and helping people really get a great diversification with their retirement money, with their long-term savings stuff. So without further ado, I'm going to just take the first portion of the hour and kind of cover what we do at Main Street Planners, and then I'm going to hand it over to Kaaren and have her explain some more in detail about her piece in the IRA puzzle and the self-directed solution. So let me just hit some housekeeping. If you have some questions over in the control panel box, there is a questions piece right there. Please click it. Please feel free to key in questions, and I will address those. I'm sure Kaaren will address those as well, and would love to get you any information that you'd love to know about self-directed IRAs and how to really put your money to work. So, what we do at Main Street Planners is we help people do personal alternative asset plans. And, we came about as a company, the Main Street Planners piece in 2012. So we're just about 3 years old. Our sister company, Asset Exchange Strategies, which is a self-directed advisory firm, has been in business for 14 years. And as we'd help people establish a self-directed scenario, they'd often say, well, where are people putting their money? Where'd the last guy put their money? Do you have any ideas for me? And so we came up with this concept of Main Street Planners, where we would go out and try and vet some what we feel is some good situations, and then give people kind of some direction of where they might put their self-directed dollars. And so as I go through this, you'll wonder why you might want to listen to what I have to say. And you can see if this rings true for you. In our view, Wall Street is still a casino. It doesn't mean all the money has to come away, but we don't believe that a complete diversification system can be accomplished staying all on Wall Street. So here, we look at Wall Street as a casino where I'm not sure the upside is worth the risk, but you'll make that decision for yourself. Here, we want to help people take control of their assets, and in our minds, what that means, what's going to make the grade for something that we're going to tell people about is it ownership of a tangible asset, meaning something you can put your hands on, meaning something that isn't subject to a financial market announcement. As we saw, when Greece went bankrupt, for instance, the Dow took a huge dive. We're also looking for better returns. We, of course, want to stay ahead of inflation, which a lot of times the tangible type of stuff doesn't feel like it's going to keep ahead of inflation. And we also want to create monthly cash flow, because without cash flow, well, that's, you're not going to be able to retire, because that stream of income hitting your mailbox every month is what's going to provide for a retirement. Now, the other thing that we really like as we look at all the different options is we like things that are transparent. And what that means is we can look at a situation and understand the risks. And then if we understand risks, then we can hedge and prepare. Just for instance, I don't have any idea what Dell stock is going to do, Dell Computer. They might have two warehouses full of machines that are going obsolete by the day. I have no idea. And then even worse, if I bought Dell Computer in a technology mutual fund where there's 200 other tech stocks that I have nothing, no understanding about, I don't have any idea there. Okay. But if I'm going to buy something tangible, maybe like a piece of rental property or a mortgage note, I know how those things work. And so I can prepare and understand. And so again, today we're just going to talk educational. We're not going to talk about any specifics. We're just going to talk about concepts. And so, a lot of people are like, well, why should we listen to these guys? Well, because we've been around the block and we know what we're doing. We've moved over $2 billion away from Wall Street over the last 14 years. We've got 5,000 going on now, 6,000 happy clients. And Dan, my business partner in the company, we've been quoted in these financial press mediums. And, we are well known in the industry. Let's put it that way. Well, the first thing that we do is we start talking to people is we want to get a feel for what their risk tolerance is. And so we've got a short questionnaire that I'll give you access to later on, where you can go in and just answer some questions about what your time horizon is, and how you feel about an increase versus a decrease. And you get an overall score based on the way that you answer questions. And then you are grouped into one of four asset allocation models, kind of depending on how you answered your questions. And so we, have found that people who answer questions like you do are comfortable with a breakdown in an asset class, breakdown like this. Maybe a portion of it into real estate, maybe a portion of it into private lending, and maybe a portion of it into metals, maybe a portion of it into structured settlements, maybe something into something we call Main Street funding. And so then we go from there and we work with an individual client to find what they're comfortable with, and we reallocate and we move money around. And then we say, all right, how much money do you want to put to work? And then we go to work and find an allocation of where that should go. And so, as we look at this asset class summary, there's some of the things that we really like. We like, individually owned small rental real estate. We like trust deeds, which is something you might know as a mortgage note. We like structured settlements. We like metals for, a portion of people's portfolio. And then we compared them with commonly held retirement assets like a mutual fund or a CD. And then we looked at it across 5 different categories. What do they do returns wise? How is the cash flow? How does it do against inflation? How secure is my principal there? How liquid is this kind of an investment? How long does it take for me to get to my money? And then we gave it a star rating. 1 star is fair, 4 stars, excellent. And there's not a perfect asset class. I bet Kaaren, wishes she could, tell everybody to find the perfect one, but there isn't one. And so we try to kind of hedge the positive against the negative in another to make sure that people have, again, a very solid platform, a great foundation to kind of build their long-term savings from. And so as we allocate, we're looking at different ways to do it. And so again, just educationally, when we look at small individually held rental real estate, we do this a little bit differently. In our mind, when a client of ours works with us, we have done the hard work already. We go out and we find distressed homes, meaning maybe they've already been taken back by a bank, or maybe they're in short sale, or maybe we're buying it from an investor that's tired of a property and it's been run down and just wants to sell it. And so we find the right property, then we go in and we do the right amount of rehab. And the right amount of rehab is a key, because tenants want to live in a certain quality. They don't want to live in something that's too nice. And of course, you don't want something that's run down. So we know the balance. We know the right amount of rehab to do. Then we find a long-term tenant, which is in our mind the most important thing, because the first tenant in a rental property is the most important one. Because if you don't get that first tenant, then your income never starts. And so you don't have that cash flow that I was talking about. And then the key that allows us to do this in many different markets across the country is to find a great property manager. It's the boots on the ground, the person that's going to take the phone call if the faucet is leaky, or it's the person that's going to, sort through and find the right tenant to live in my house and to take care of it, and to really kind of carry again the bulk of the contact with the tenants. And so when we believe that we've got great property managers, then that allows us to search across the country and find the areas that are going to give the best rate of return, the best overall situation for the property owner. And so we utilize numerous data points across, we look at probably 16 or 17 different data points that tell us what the best market is to choose. And then when we know which market we want to be in, then we can go in, buy the properties, get them rehab, get long-term tenants in place, and then find the best property managers in the area. And so when we do real estate, it's like that. When one of our homes gets sold, it's already had all that process completed. And so one of our great asset classes is small individual rental properties. And so as we do this, we really like it because you own collateral, you own something. And so a loss or a frustration for owning a property is different than a frustration of something on Wall Street where you lose principal at Wall Street. Here we don't really lose principal. Maybe we lose a rent because our tenant is out and we're turning over into a new tenant, or maybe we had to do some property maintenance. But again, as I mentioned earlier, if we know the risks, we can prepare for them, and then we're more ready and prepared to do it. And so, a loss is very different with this kind of an asset than something we'd find in Wall Street. Another thing that's really nice is right now we are in a window of time that's pretty unique. Rents costs of rent in a rental property stayed very consistent throughout this recessionary period that we've been in. However, the price of the houses has really dropped. And so what it allowed us to do, it allows us to buy the asset that's generating that cash flow at a significant discount. And so it allowed the returns for this window of time to go up because I'm getting the same rate of return, I'm getting the same cash flow, but I paid less to get it. And so that means my dollar is working harder and more efficiently. And so because the rent stayed high, we've got great returns. And so it's an interesting time to consider owning these small individual rental properties. And we think it's important that people own them individually because then you can make decisions based on what you need to do. If you need to liquidate a property, or if you find something else that you want to go put your money to work in, then you can make the decision to sell the property. Whereas if you're in a co-op or some other kind of group, then you're kind of subject to the group. And so again, we are very individually oriented. We're going to tell you to do that and maintain your own control. The other thing that we have is we have the opportunity to gain leverage with these homes, which means we can do financing on the properties. And what the leverage allows us to do is to gain higher returns for our invested dollar. And then, if for instance, I can find you a loan for 50% of the purchase price, even if you're using your IRA money or your 401k money, then that would maybe allow you to buy two different properties. And so it allows you to diversify further within the real estate portion. So maybe you have a property in a market like Indianapolis, and maybe you have a property in like Birmingham, Alabama. And so again, it allows you to further diversify where your money is working, and it allows you to kind of benefit from what might be going on in that market. Maybe there's appreciation at a different time in Alabama than there is in Indianapolis. And so again, further diversification is awesome. And so you can take the potential increase in property values in two homes instead of just one. So leverage is great for us. And so let me give you just kind of an idea of what we're looking at when we consider a market. And you could use this and apply it in any market across the country. But we look at three categories, and I've put it in this thing we call the buyability matrix. And so the first column, you'll see the interest rate percentage, and that's just the rate of return column, and that's pretty cut and dry. There's not a lot of determinations. It's not subjective. It's pretty much the numbers. But what's the rates of return? And we've got a 1-star, a 2-star, and a 3-star. And then in the middle, there's that's that pyramid. That's the stability column. We want to know about the market, about the neighborhood. And then the third column that we look at, that we grade, is the cost of ownership. And what that means is, what did it cost me while I owned it? And we'll talk a little bit about that. And as we look at these three things, we've been able to encapsulate all of these 17 different data points and kind of illustrate it here, so it helps us kind of focus on a market. And the idea behind it for us is really to just simplify the real estate buying decision. And it helps us to incorporate all of those different factors. Now, the most important thing is it doesn't eliminate the need for due diligence. And all the time we're going to suggest due diligence because you want to know what the heck you're going into. You want to go in with eyes wide open so you have an understanding. But again, what I love about our model is it's transparent. And so it's easier to understand your risk. And again, when you understand, you can hedge and prepare. So let's talk a little bit about the return column. This incorporates what we call a cash on cash return, which is simply how much return for the year do I earn on my invested dollar? It's cash on cash. So, did I make a 10% return? If I had 100,000 and I got $10,000 in return, of course, that's a 10% return. So this is, not subjective at all. It is the numbers. The other thing we look at is called an income to price ratio. Now, the income to price ratio is something that you want to look at, and why you might want to consider a market away if you buy real estate. from your home market. A lot of people are like, you know what, I really want to be able to drive by a rental property on Sunday and see if my tenant is cutting the lawn. But they don't want to, they're uncomfortable with being out of their market. And so, for instance, I live in Salt Lake City, Utah. So in Utah, if I wanted to own maybe a small rental property that had an $800 a month rent, I'd probably have to pay about $150,000 to $175,000 for that property in Salt Lake City. Now, if I took that same $175,000 and I went to a market like Birmingham, Alabama, I could buy 3 or 4 properties that are probably going to cash flow me in the $700 to $800 range. And so in my mind, I want to go where I get the highest income for the price that I'm paying, or the income to price ratio. And that's something that you'll have to square with if you want to, put your dollars to work in the highest value locations. And some people really feel like they want to drive by on Sunday and see if that lawn's being cut. And I often want to say, well, that's fine. Do you only invest in Wall Street in companies that are in your local city or your local state? It's kind of like, if we could rely on the property managers and let them do their job, kind of like relying on a Fortune 500 company's management team. And then a potential appreciation. That's a little bit subjective, but the other two are just plain numbers. And so to us, a 1-star is less than 12%, a 2-star is 12 to 18%, and then a 3-star is an 18% plus return. And utilizing leverage, we have these kinds of returns, so we can find those. Stability column. This to me is the most important one. It's the strength of the property manager, again, which is the key. How are they keeping the house up? What kind of tenants are they plugging in? Are they responsive to my requests? This is important stuff, and we've really had to vet those out, and we really value our property managers. If someone buys a property from us, they don't have to use our property manager, but I'd suggest that you do, just because what we say and our business with that property manager probably swings a little bigger stick than yours would with someone else. To us, also very important is how diverse are the employment options in an area. There are properties available in Las Vegas or Detroit. But the crazy thing is, because those were kind of single industry dominated cities, when automotive is on its ear or entertainment is off, then where are the tenants living that I want to live in my house? Where are they going to get a job? And so we want to be in a location where there's lots of industries that aren't determined on just one not just dependent on industries, or dependent on like in Vegas on entertainment, or on automotive for Detroit. Also, what are unemployment trends like in the area? Are they on the way down? Another thing we want to know is how friendly is the government towards landlords? And then we want to know, what are crime rates like in the area? And we've got some tools that we'll mention here that you can learn about and figure all that out and get a great feel. The third thing that we've got is the cost of ownership column. This incorporates things like, okay, what can I expect to pay in maintenance on this property over the term that I'm going to own it? One of the things we look at here is age versus the effective age. And if you've gotten an appraisal on your current home where you live, if you've done some remodeling, then maybe the appraiser gives your home an effective age that's different than the year it was built. For instance, if there's a home in my neighborhood that was built in 1950. And the widow just barely passed away, and the property is finally going up for sale. It's largely the way it was built in 1950. And so if someone buys that home, the effective age on that thing is 65 years, because they haven't done anything. Whereas if there's a house across the street where someone came in, bought it, redid everything, like they redid the heating, the air conditioning, they redid the plumbing, they redid the roof, they redid the windows, they've redone the bathrooms and the kitchen, kind of just redone it, then the appraiser comes in and says, well, technically this house is built in 1950, but it's really effectively maybe 12 years old instead of 65 years old. So effective age kind of tells us a little bit about, how much the property has been updated. And then again, what would you expect to pay on maintenance costs going forward? Another thing that's important is curb appeal. And this is a subjective thing, but we look at it and we want to know, will this property rent quickly in the area? Will it resell quickly? And then we want to know, what's the ongoing maintenance potential here? And then how easy is it to resell? And so this is a subjective thing that we have to add in, but that's kind of what we're looking at. It kind of helps us incorporate what we're thinking about a different area. And so as you're evaluating real estate as an ownership, as an asset class, consider some of these things. And you can utilize some of these tools that I'll tell you about here in just a minute. That'll give you more info. Okay, here's a snapshot of one of the markets that we really like, Birmingham, Alabama. And this market, I don't know what you think of it, but you'd be blown away what Birmingham is. And we'll talk about why it's what some of those great factors in a sec. But let me show you again just some metrics and how they look at it. Now, the top left, this is a median price chart that the realtors use. And so you can see that the prices were up and then they've dropped. And then you'll see the tail there is starting to peak up. That tells us, obviously, that prices have started to come up and we've got, it's a good time to buy. Okay, top right, local inventory for Birmingham. Okay, number of properties available on the market. If there's fewer properties, then they're going to stay on the market a shorter period of time. Because if I've only got 3 to choose from, I'm going to choose one a lot faster than if I've got 30 to choose from. And so as the inventory is down, then we know that the prices have started to stabilize. Because if I've only got 3 to choose from, I'm probably going to make my best offer instead of trying to lowball. Okay. Another thing that comes into play is average days on the market. That's the bottom graph there. And that again tracks how long it's been sitting on the market. And if you think about this, if you're trying to sell your house and it's been on the market for 90 days and you don't have it sold, you call your realtor and say, lower the price, please. We're obviously not priced right. So as we keep dropping and keep dropping, the longer it stays on the market, prices are dropping. So we can see that they haven't rebounded. Where on the other hand, if I put my house on the market and it's priced right, I get an offer in the first week. That thing goes to, a mortgage company and they buy it for me in 40 days. So that meant that it was priced properly. So that means that the prices are stable or moving up. And so again, we use these numbers to tell us what markets are like. Birmingham is a market that we really like. And, this is a place where it is, the vibe there is young and hip. I had no idea 2/3 of that city is medical. The University of Alabama, Birmingham is the biggest employer there, but they also own about 2/3 of the real estate in downtown. It is very medical. There's 2 or 3 massive banking towers. I mean, this is very banking, very medical. It's also nice that housing here is affordable. So that means people have the money to pay their rent. Cost of living is 20% below the national average. Here's where we get a very high income to price, meaning I could buy 2 or 3 properties with my money I've allocated towards real estate instead of just one. I told you the university is already the largest employer. Unemployment is very low there. Our rehab there is excellent. We've got a great property manager there. And we think there'll be good upside for appreciation. But even if it doesn't, we look at our numbers just based on cash on cash. So that's good stuff. Another market we really like that you may want to consider is St. Louis. This is a place where, it's a top city to live and work. We've got lots of pro teams there. It's very family friendly. We've got 10 Fortune 500 companies, so I've got a diverse employment base there. I'm in the top 20 nationwide for affordable housing, meaning that cost of living is low. And again, people have the money to pay the rent and still live. We've got great business tax breaks, so that means that there'll be good potential in the future to have new companies come in. In our areas there, and we go in and we pick and choose certain zip codes where we want to work. And in our certain zip codes there, this is where blue collar goes to get away from crime. My business partner said it felt like Mayberry from the Andy Griffith Show way back in that area. And we've got a very strong property manager, and their enforcement there is very interesting. The government sends people around and writes tickets if people don't take care of their yards. It's very interesting. But again, I'm not going to take forever. I want to get this over to Kaaren. But one of the things that it doesn't do, as I mentioned, is it doesn't eliminate due diligence on every property. We always check a title report. We always buy title insurance to make sure that our ownership is in the form, for the IRA to own, or if someone's going to buy it just individually. But we make sure that they're the owners, and then we always suggest people use an independent home inspector. This is the guy that knows more about houses than you and I will ever know. They go in and they climb up on the roof and they tell us how much roof, how much time is left on the roof before it needs a replacement. And they crawl on behind the heater, the water heater and the furnace, and they tell us what's going on. They check the plumbing and the electrical. They tell us the stuff we need to know. And so it makes us a lot more comfortable to do business in an area that's away from our home market, because we've got someone who's an expert there that's on the floor, on the ground. Another thing that we can do now is we can go in and use technology to help us understand more about the areas. Like you can go in with Google Maps and Google a neighborhood, and it'll show you the overhead of the area. And you'll know, is this across the street from an elementary school or near a factory? So you know kind of about the neighborhood and what's going on. We use this site, CLR Search, to tell us about demographics per zip code. This tells us about crime rate and how it compares nationwide. This CLR Search has more demographic information than you'll ever use. It tells us about the employment status of the two adults in the home. How many kids do they have? Are they in school? I mean, it is amazing. But there is so much technology available to us now that really allows us to do this kind of real estate investing away from our local market that we didn't have 10 years ago. And it's great. But here's what we need to know is there's always risks. And the question is, what risks are you interested in? But the risks for rental property is no rental payment. We may you'll have a tenant that'll turn over. On average in our properties, we usually see them happen about every 24 months. We have a turnover. There's a risk when it turns over. You live in a house, things get damaged. Sometimes a tenant is rougher than another, but even if your family's careful, things get damaged. So that you'll have to have a slush fund or a maintenance fund to cover that stuff. Things break down, water heaters go out. And so, if there could be a failed maintenance program, and one of the things that we do to kind of address all these things is we have a 5-year expected life on all of the major systems. Someone makes a decision about that. Could they be wrong? Yeah. But again, the idea is we try to vet it out and try and minimize the damage to people, financially. Could there be a physical or structural damage? Could a tree fall on a home? Yes, it could. And hopefully we've got homeowners insurance to cover that kind of stuff. But, these are the risks that we need to know. And then local, regional, and national market conditions, things could change. We could be in a recession. But these are things that we know and understand because we live in a house every single day. And so that's one of the things I really like about it. Another asset class that we use is private lending. And private lending is the banking side of things. And the simple fact that banks do this tells me that this is a good place to put my money. But what we show here for our clients is the opportunity to be the bank, which means that they are the mortgage holder. Okay, so they are in line to collect a payment every single month, and it is genius. You don't have to worry about ongoing maintenance of a property. You don't have to worry about paying the taxes. You don't have to worry about paying the homeowner's insurance, and you don't worry about vacancies stopping your income because it's a mortgage payment and it needs to be paid every month. The nice thing about it, it is guaranteed by collateral because you are on title, which means that if the property is ever sold, then you're first in line to get paid. It's also secured and protected on the homeowner's insurance. We put you on the farmer's homeowner's insurance policy. It's your IRA, or you personally. And so again, if there's damage to the property, you get paid first. And I love that we are guaranteed and protected. And this is fixed returns paid monthly. Again, it creates a cash flow that lets us retire. And so we take this very comfortable spot that's normally held by the bank. And we've got a situation where our buyers of the property are in love with the property, and they're bringing in 50% of the purchase price to buy the home. Now, I worked in mortgage finance for about 13 years, and if I ever had somebody bringing in 50%, that mortgage loan was very easy because the risk to the lender was very low. And so it's interesting. If there's a default, it's probably good news. But if there's default, you own the home, and then you can resell or just keep renting. And the numbers are great either way. This is an awesome place to have your money. It's a great CD alternative right now, in my opinion. People are getting 1% to 2% on a 5-year CD. We can do a lending scenario and get them in the 8% range. So, and what I think is a similar risk, but that's me. But when someone's using their retirement dollars, their IRA or 401k, if they're going to use a loan, the type of loan is mandated by the IRS, and it has to be what's called non-recourse, which means no one is on the hook for the loan if there's a foreclosure. So what that means is if there's a default, then the IRA or the lender here just takes over the property, and if they sell it, what they get is what they earn from the sell or the foreclosure sale. They can't go back to the borrower and say, I only got $50,000. Your loan was for $70,000. You need to pay me the $20,000 difference. And so the IRS has said it cannot be recourse, it has to be non-recourse. And so the way lenders offset that risk is they make buyers bring in more money down. And so IRS requires to do this. There's really only one bank nationwide that does non-recourse loans, which is what people buying with an IRA need. And so we have found that our clients really like to step in and do these smaller loan amounts and be the lender. So maybe it's $18,000 to $30,000 on a smaller loan amount. But again, they're lending half of the property value. And this is a 5-year balloon, and interest rates are in the 7 to 8% range. A 5-year balloon means that the borrower is paying interest only. And at the end of 5 years, you as the lender can make a decision if you want to go ahead and do this again or if you want to get paid off. And so it gives you an out, and then you can look at market conditions in 5 years, and maybe a CD at the bank is paying 10%, 12%. Then you can take that money and go put it in the CD in the bank. If it's still upside down and backwards with CDs and it's only paying 2%, then redo your note again. But this puts you in control to have access to your money to move it. And again, lower risk here because usually an IRA is the borrower. And let's be honest, when you've got 50% down, you're not going to default because you have a lot of skin in the game. And here's kind of a sample. Here's a note that was $23,000. The purchase price on the property was $47,500. And so the interest rate at 7% was $1,662 a year. Every month, $138 gets deposited in their account, and we set it up on a kind of an ACH, and so it just shows up there on the 15th. And so over 5 years, that interest collected is $8,312.50. So a decent rate of return for money that is secured in a tangible asset. Now, what if there's a default? Then I say in this case, you've won the lottery, but you've got choices. Now, there'll be a foreclosure process if it's with the IRA. It's not going to be difficult. There's going to be some financial or some legal expenses. So you take over the ownership. So if you want, to me, you can just keep renting, drop down to the very bottom. So let's put a new tenant in place. So the net return on that property to the owner was $5,329. You're in it somewhere around $23,750. So your rate of return there is 22%. Not bad for being in a place where it's tangible and cash flowing. Okay. Maybe you want to sell it. Forget it. I'm done being a lender. I don't want to own real estate. I'm going to sell it. So call Century 21 and have them put a sign in the yard and have them sell it for 90% of the price that the person paid for it. So maybe they sell it for $42,750. You're in at $23,750. So maybe you got $19,000 out of that transaction, plus whatever payments you'd received to that point. But to me, the very best situation is to put a sign in the yard that says seller financing, which means there's people out there that can't get a bank loan right now. Maybe they had a bankruptcy 2.5 years ago or a foreclosure where their credit score is just too low, but you can look at it, you can vet them out, you can see if they've got a good job, and if they're willing to put some money down, maybe $5,000, that pays certainly for your legal fees, and then you create a mortgage payment for them that's equal to the amount they've been paying in rent. And so this home is a $700 a month rent. So you say, all right, well, you give me $5,000 and I'll make a mortgage note with you for $43,500, which is 10% return for 10 years. So they'll be paying you $574.86 a year for 10 years. The difference there, $125 or so, goes to pay for their taxes and their homeowner's insurance. So they're owning a home within 10 years for what the price would have been for rent for them. So suddenly somebody who's rented their entire life is now a homeowner. How excited are they about owning a home within 10 years? And how excited are you because $574.86, 120 payments of that is almost $69,000 coming back. And if they default in a year or two, do it again. That just seems like a way to multiply money. Well, I don't want to go on and on and on, but we've got some really nice asset classes that are tangible, that provide cash flow. And this is kind of the start. As always, we want to talk about risks. Know the risks. They're just the same. Well, very similar. Homeowner's insurance could lapse, okay? One of the things you want to do is make sure that the homeowner is paying their insurance a year at a time. That way, you check once a year. Just make sure it's paid up. Make sure you're the lost payee on there. And we help our clients do that. But you just get proof of insurance, the evidence of insurance, and you're the lost payee if something happens, if a tree falls on the home or it's destroyed in some weird way. There is a possibility of a default from the borrower. And again, whether that's good news or bad news, you'll have to decide. There's always a risk of a borrower paying slowly or getting behind. Maybe the tenant isn't paying rent, so your owner is slow to pay you. It's possible. It's possible that you could own the property and take it back in foreclosure, and there's been some tenant damage or mechanical failure or some physical or structural damage. But again, hopefully we've got homeowners insurance that's going to carry most of the risk there. Then there's local, regional, national market conditions. But again, I think these things are more transparent. Risks are something that you can see there. So another thing that we've got that I'll just make mention, and then I'll hand this over to Kaaren, is we do a situation where we do what's called a managed account, where we help our clients avoid compliance failures. There's just a couple of rules with self-directed IRAs if you're clear on them, but sometimes situations can get murky. So we'll help avoid that. We'll help with tax reporting. We'll help with keeping LLCs compliant with the state if we create a self-directed IRA, what we call a checkbook IRA LLC. Well, it can help you with redirecting cash accumulation. If you're not ready to start taking cash flow, if you want to leave it and reinvest, we do that. We do annual rebalancing, and help avoid the penalties that come to IRAs. And the penalty for misstepping here is steep. It's 10% of the entire balance, and so we want to stay away. We don't care if it's an innocent mistake. We've seen a realtor selling and taking a commission on an IRA-owned property that was their IRA. That's a 10% penalty to the entire IRA balance. So heavy. And then, of course, we'll help you avoid self-dealing, which is someone who is a direct ascendant or descendant benefiting from a property or an IRA-owned asset. And these are things that Karen's group will help you avoid as well. And so, Kaaren, I'm going to, at this point, kind of hand this back over to you. Are you ready to take this thing over for a little bit?
I sure am. Thanks so much, Gary.
Okay, I'm going to change presenter, and hopefully you'll be able to grab this back.
Excellent. I greatly appreciate that. So now that everybody knows, so much has been greatly enlightened by Gary, I guess I'll say it that way. I'll talk about self-directed IRAs and how they work and how it's great for you to use them. And hopefully this will shed a lot of light on how to use a self-directed IRA really to increase your overall investment portfolio and also your retirement health. We'll get to that in a second. So when it comes to self-directed IRAs, what we do is we help you move your money from here to there, really, and get self-directed IRAs into your retirement account. What we don't do is give you tax and legal advice or tell you if something is a good or a bad investment. We also don't endorse any particular investment. We're here to help you self-direct your IRA. And when it comes to saving for retirement, I don't think I need to tell you, although I'm going to anyway, how really unprepared Americans are for retirement. There is a great deficit between what Americans have and need for retirement. So whatever you do, sock some money away, save for retirement, and a self-directed IRA is one of the tools that can help you do that. If you're raising capital, the total of retirement funds is something like $23 trillion out there, and only 3 or 4% of it is in alternative assets. So there's a huge pool of money. How do you tap it? The way you tap it is you talk to people and you say, do you have a 401k with a previous employer? Or do you have an IRA today? And if the answer yes to either one of those, they can take that retirement money and probably invest with you, assuming, you've got to work out all the details, but more than likely they can use that money to go into your deal. So if you or if your clients haven't heard about self-directed IRAs, you're really not alone because not a lot of CPAs and attorneys really know about this. I still get the occasional email where someone says, yeah, my CPA says that my IRA can't buy real estate. And so that's always amusing, but of course you can, and you've been able to do it for 40 years. Gerald Ford signed the ERISA laws into effect in 1974. They went to effect in 75. And so it's been all that time that you've been able to self-direct an IRA. It's not new at all. And the only difference between a regular IRA and a self-directed IRA is the asset that the plan can buy. So the kinds of IRAs are always the same. It's a traditional, a Roth, a SEP, a simple, an inherited, maybe a spousal IRA. That's the same, whether it's a typical or self-directed IRA. The difference is that with a typical IRA, it's just in stocks, bonds, and mutual funds. And maybe you get to choose what stock, bond, or mutual fund it is, and maybe your company or where your IRA currently is sitting tells you that their IRAs are self-directed, and maybe they are because you can choose what stock you want. But a truly self-directed IRA lets you invest in real estate, private stock, make loans. You were talking about trust deeds and things like that, private lending, raw land, multifamily, all different kinds of assets. So that's the difference. The difference is what asset can you invest in. With the self-directed IRA, the gates are pretty much wide open. As a self-directed IRA investor, it's important to understand how many things you are taking on the responsibility for on your own, that you're self-directing it. And that regards the due diligence. What about losses? What if your IRA loses money? Well, of course, you're the one who has selected the asset, and so we are following your instructions. So if you lose money, there's really not a lot that you can do about it. You don't get to take a tax deduction for the loss like you would if it was your private cash, and contribution limits are, well, limited. So it's hard to replace those losses. So nothing replaces due diligence on a self-directed IRA investment. Just so crucial. Google the names of the principals of the deal that you're working with. If you're not doing a deal directly, if you're working with others, who are they? Have they ever been incarcerated? And I laugh because just because it's so true. We've had our account holders go to invest with people only to find out later that they had been, served jail time for stealing money from people. So you want to make sure you know who you're investing with. Do your due diligence. What are the limits? Well, it's nice that the IRS doesn't tell us what we have to do. It just mostly tells us what we can't do, so it's a short list. The list is that our IRAs are not going to be investing in life insurance contracts. Okay, that's one. And collectibles, that's the other. So no fine wine collection in your IRA, no collectible cars or paintings or anything. Other than that, it's pretty much okay in a self-directed IRA. But what if your funds are with your current employer? What if you have a 401k with your current employer, not just a previous employer? Truth is, your plan probably will not allow you to self-direct your IRA, and you really have to wait until you leave the company to roll over that retirement money. But there is something you can do. You can go to the plan administrator and say, hey, look, I would like to do an in-service transfer, meaning that you're still working there, you're in service, and you'd like to transfer the money. And sometimes companies will let you do that, sometimes. Where is it written? It's written in the plan document that company has. So whatever their plan document says for that 401k is the rule for that particular 401k plan. So again, if you want to use the funds from your current employer to self-direct, probably won't be able to do that. Pretty much have to wait till you leave employment. With self-directed IRAs, we really have to talk about the rules. And of course, a self-directed IRA gives you great freedom. There's so many things you can do. But it's just irresponsible not to talk about the rules, because it's not just like investing your personal cash. And there are things that you might assume that aren't going to be true in the final analysis. So let's talk a little bit about the rules, because what I would like you to have as a takeaway from this event is the right expectation for what a self-directed IRA should be and how you should work with it. So number one, you're not going to borrow money from an IRA for personal use. You don't sell anything you already own to the IRA. Your IRA is not security for a loan. And you don't use that IRA to buy property for personal use, present or future. All right? But as we go a little bit deeper into the rules, you need to understand that there are qualified and disqualified people, or allowed or disallowed. So the disqualified people are your lineal ascendants and descendants, your parents and grandparents and their spouses, you and your spouse, and then your children and your grandchildren and their spouses, all disallowed or disqualified to your IRA. But the people who are qualified, well, they're out to the sides on the family tree, like your aunts and uncles, your cousins, nieces, nephews, brothers and sisters. They're allowed. Okay, so those are qualified people. So when it comes to the rules about self-directed IRAs, it's a game of keep away, and you're keeping away from prohibited transactions. I got a call just today about, it was someone's advisor saying, hey, I've got a client and they want to take their self-directed IRA and buy a house their dad owns. Well, number one, neither you nor a disqualified person can benefit from the IRA. And number two, you can't buy, sell, or exchange assets between the IRA and someone who's disqualified. So you just really can't do that. So to further highlight number one, personal benefit, present benefit, indirect benefit is not allowed. The IRA is for investment purposes only, and it's for retirement purposes only. So you're not going to have any benefit today from that IRA account. That's really important to know. And as I mentioned, you're not going to buy, sell, or exchange property between the IRA and any of those disallowed people, but you can transfer upon death, just so you know. And number three, a disallowed person isn't going to provide goods, services, or facilities to the plan. So what does that mean? It means that maybe your son is a realtor and you want your son to be the listing agent on a property your IRA owns. Well, your son is disallowed. He can't provide services to the plan even for free. You see how that works? If your IRA owns a house, you can't go in and paint the walls and swing the hammers because you're not allowed to provide, they actually call that an over-contribution of sweat equity, and you're not allowed to provide services to your IRA-owned assets. So you need to keep everything arm's length. So again, with the expectation of a self-directed IRA, really there are multiple parties involved here. There's you, the account holder, and then there's your IRA. So with a self-directed IRA, what's so important is that you're not signing the documentation because you're not investing. Your IRA is investing. Therefore, we sign on behalf of your IRA. So that's really important to know because when you're investing personally, you get to sign all the documents. Well, when your IRA is investing, we sign on behalf of the IRA. Then there's UDirect IRA services. We're your point of contact for everything in regard to this transaction. So your point of contact from the time you open your account till the time, that we pass the account on to your heirs. We are the point of contact. And when I founded UDirect IRA services back in 2009, I shopped around for a custodian to hold our clients' funds, and I chose a trust company custodian. And what I liked about that is that they're non-depository, meaning that they don't have checking and savings accounts. The money isn't coming in and out all day. They're not making loans to people, so the funds are not at risk in that regard. So we've had a long and very good relationship with the trust company custodian. And so these are the players in the game. When you self-direct your IRA, this is what you need to keep in mind. You'll be working with, there's you, your IRA, UDirect IRA services, your point of contact for everything, and in the back office, our trust company custodian. Let's talk about buying real estate. And I want to talk about that because it's probably the number one asset that our clients invest in. So pros and cons with investing in real estate, just like really anything else. The pros are that, hey, the gain comes back in tax-free in a Roth or tax-deferred in a different kind of account. That's great. Don't have to pay income tax now? Love it. Number two, no time limit for holding that property. So what that means is your IRA can buy the asset today and sell it tomorrow with no ramification, except for maybe profit or loss, So no time limit, no clock ticking. The IRA can actually borrow money, which we'll talk about, whether you want to or not. But I think the biggest pro for investing with your self-directed IRA into real estate is the potential to earn a larger rate of return. And that's because when the return comes back, it's not being diminished by tax, and the entire return can go back out into the next deal so you can compound your earnings even faster. The downside about buying real estate with an IRA is you're not getting the other tax advantages of owning real estate, like deductions and things like that. So keep that in mind. If you've got the choice to invest with your IRA or not, where does it make more sense? Pencil it out with your CPA where it makes more sense. But of course, you, as a self-directed IRA account holder, are responsible for all the gains and losses because, of course, you're selecting all the assets that are going to be invested in. Just as we call our company UDirect, you direct us to place your funds into assets that you choose. And again, you can't replace losses very easily. So those are the things to consider. I mentioned just a moment ago that an IRA can borrow money, and it can. Having been previously a lender myself, residential lender, I was very surprised to learn that an IRA can borrow money. It's a non-recourse loan. It's not. I'll tell you what, your IRA does not go get a Fannie Freddie conventional conforming FHA VA kind of a loan because there's no recourse. So the IRA has to obtain a loan from a special lender. It's like a commercial loan called a non-recourse loan. And upon default, the lender can only seize the subject property. They're not going to come after you. They're not going to come after any other assets in the IRA itself. So that's good to know. It's a non-recourse loan. And not a lot of lenders to choose from. We do have a list, which I could share with you if you'd like. These lenders require a larger down payment, 40, 45, 50, 60%, depends upon the risk, I suppose. And of course, you cannot personally guarantee a loan to the IRA. That is a prohibited transaction. No, you're disqualified to the IRA. Providing a personal guarantee would benefit the IRA, and so you can't do that. So you may have a non-disqualified person do that, but you're not going to guarantee any loan to the IRA. Before you decide you're going to have your IRA take on leverage, consider this. It's tax. We invest with IRAs because we like the tax-free, tax-deferred status, but there are two times when an IRA can be taxed. So walk in with your eyes open and understand there's UDFI, unrelated debt financed income tax, and that applies when your IRA takes on debt. So the profit that's received because of debt is taxable. Good conversation to have with your tax advisor. Also, your IRA can be taxed when it is invested in an entity that engages in a business that isn't unrelated to its primary purpose. And again, this is IRS language. So talk to your tax advisor. Go online, go to irs.gov, read publication 598 so you can learn more about it. These taxes, they're reported on a Form 990T, so you have your tax person put that 990T together for you and you file it every year. So before you do any of these things, understand this tax may happen, and you just want to make sure that that you're in the clear there. Or if you're not, that you understand how to work with it. Okay, how do you get real estate into an IRA? All right, we know how to get a stock in an IRA. You go in your computer, you just click a few keys, and boom, your IRA owns, a stock, for example. But in a self-directed IRA, first, if you're buying real estate, you're buying real estate, and so you're dealing with all those parameters: escrow, title, maybe you're an attorney state, whatever it is. But the best advice I can give you is before you have your IRA buy real estate, open the self-directed IRA. At least once a week, we get the phone call that someone has put a deal into escrow. They're ready to buy that deal. They've signed it in their personal name. They've maybe even made an earnest money deposit. Now they want their IRA to buy it. Well, your IRA can't buy an asset you have a personal ownership interest in. So you can't buy that property. You've got to exit that deal and re-enter as the IRA because it's the IRA as the buyer. You don't sign the offer to purchase, we do. So you give us our form called a direction letter, very basic form. You give us the supporting documentation, which is the offer to purchase, and we put them together and we review it. And assuming everything's perfect, the money gets wired, you fund, you close, you get your keys, your tenants move in, and they make their check payable to the custodian for the benefit of your IRA. Now, this is a good place to mention that a property manager can really be a self-directed IRA's best friend because the property manager can collect on the rents, and then your tenants can make their checks payable to the property management company. So there you go. Now here's an example that kind of goes in the face of what I've told you. We've got a father, we've got a son, and we're going to show you the exception to the rule. Father and son are disallowed to each other. But in this scenario, what they're going to do is they're going to go in and buy a condo or a house. So dad's got cash, the son has an IRA, and they're going to buy this, and it's going to read like this. Title will read, custodian for the benefit of the son's IRA, 50% owner, the dad, 50% owner, tenants in common. But hey, wait a minute, before the deal, aren't they disqualified? Yeah, but it's because the father has no ownership interest in the property, the son nor his IRA has any ownership interest, not at all. It's because it's a new deal that they can close concurrently and bypass that indirect or that rule about not dealing with disallowed people. It's kind of a loophole. After the deal, after it closes, that's when that disqualified person rule comes into effect. And at that time, in this case, neither the father nor the son are ever going to buy each other out. None of their ascendants or descendants are ever going to live in that house. So there you go. And after the deal, any profits that come back in the IRA are split. Half goes to dad. In this case, it happens to be a 50-50 pro rata split, but it could be whatever it is. And in this scenario, the son's traditional IRA is going to receive half the profits. Same thing with the bills. All expenses of a self-directed IRA are paid for by the IRA. And all expenses must go back into the IRA that created, this investment. So it's not okay to have your IRA buy a house and then send the rent checks to a different IRA across the street. That's not okay. So here you go. That's how it works. When it comes to real estate, as we all know, real estate is a kind of asset that has, expenses. I think there's no way around that. So and all, of course, like I just mentioned, all expenses of the IRA have to be paid for by the IRA. So what do you do if the IRA runs out of money? Well, here's a list of 6 things. Number 1, you can write a check and make your annual contribution. Now, your contribution limit is going to be dependent upon your account type, your age, and your income. So that's a good conversation to have with your tax advisor. Number 2, you can liquidate other assets in your self-directed IRA. Like maybe you have some gold bullion and a piece of real estate. You could sell the bullion and put the cash in there and use that to pay the shortfall. If your IRA doesn't have enough money, you could transfer money from another retirement account. Maybe liquidate some stocks and bonds or whatever, and then move that money over. Your IRA could take on a partner as long as they're not disqualified, and the IRA could get a loan, a non-recourse loan, which in this case would probably be from an individual because I don't think an institution would make a loan like that. And if all else fails, you can just sell the asset. Okay, you probably heard of this. There's something out there called the checkbook IRA, which is a terrible name because it's not really a special kind of IRA at all. And the other misconception about this is people may assume that when they open a self-directed IRA that it comes with check writing capability. It doesn't. Your IRA can invest in what's called an IRA-owned LLC. So you have a self-directed IRA that's open and has money in it. You have a third party open a special purpose LLC. You can't create that LLC yourself. It's a special purpose LLC with special language. So it's not going to be prepaid legal. It's not going to be a LegalZoom.com. You want to get someone to do it who knows what they're doing. And what happens is your IRA buys 100% of the initial units of this LLC. Now you're the managing member. The money goes from your IRA to the LLC's checking account. As a managing member, you've got check writing authority. So that's how that works. Now, of course, there's a tremendous amount, really, of responsibility that comes with having your IRA invest in this way because you want to make sure you're not committing prohibited transactions. But it is a tool that you can use. So moving on, what can be self-directed? We always talk about the self-directed IRA, but it's a lot of other things. All of these plans you see here can be self-directed. The traditional Roth, SEP, simple, spousal, inherited IRAs can all be self-directed, but also the individual K, for example. It's a 401k for one person, sometimes called a solo K, a 1K. It's a 401k for a self-employed person who has no full-time employees in any of the companies that they own. Other plans are also self-directable that aren't retirement accounts at all. So just keep in mind that a self-directed IRA, all these things can be self-directed. So how do you do it? We like to say it's as easy as 1, 2, 3. Of course, there's details, but it's open, fund, invest. Open an account. Go to UDirectIRA.com, click Get Started, and open an account. Click on the application, fill it out, give us a copy of your driver's license. Then fund your account, either by contribution, where you write a check, do an IRA to IRA transfer, or roll over a previous employer plan. So once the account is open and it has money in it, then you tell us what you want to invest in. You give us a direction letter. You give us the supporting documentation. We review it, and then ultimately we fund it, and the funds go out into your deal, and then all the proceeds come back into your self-directed IRA. And that is how the process does work. So open, fund, invest. So this information I've gone through fairly quickly. And if you've got questions, I would love to answer them. So please do contact me. My email is khall, Khall, at the letter U, UDirectIRA.com. I can send you a copy of our non-recourse lender list, for example, if you'd like, or answer any questions. So with that, Gary, I'm going to turn things back over to you, and thank you so much for letting me be a guest on your event today. I greatly appreciate it. And I guess Gary will be back in just a second.
I guess I should unmute myself, right? Kaaren, can you hear me?
It helps, yeah.
Okay. Hey,
There we
thank
go.
you.
Hear you
Man,
perfectly.
I learned some things. So thank you for taking your time and sharing your expertise. And I have a client that I talked to today that I'm sending your way to you direct. So
Oh, thank you.
I'll get with you a little bit later. Hey, I wanted to share a couple things in my contact information as well for people that are still kind of sorting through all this. We've got a report that's available that talks, we call it the big ugly secret, that your IRA 401k brokerage doesn't want you to hear. And it's basically some more information about what Kaaren said, that, this has been available since 1974. There's nothing new here. It's just that your broker doesn't want you to hear it because he doesn't want you to take the money away. Oh man, looks like I just erased the link. That wasn't very smart. Oh no, that's
Control
trouble.
V.
Control V. Yep, and I just tried it, so we'll see. But it is at mainstreetplanners.com and forward slash. Let's see if I can put it back. Control V. Nope, it's not there. Go to mainstreetplanners.com and then forward slash bus. And so worst case, you can send me an email. So here's my email address, Gary at mainstreetplanners.com, and I'll forward you that since I fumbled that. Also, if you're interested, we'd love to give you access to our asset allocation questionnaire, where you could just kind of walk through and kind of see what your numbers look like and maybe what kind of breakdown for assets that you might have from our viewpoint. And again, if you want to just shoot me an email at Gary at mainstreetplanners.com, I'll get you access to and or the asset allocation questionnaire and the big ugly secret. So we'd love to give you that. Direct line for me, 801-673-6555. And Kaaren, thank you again for your expertise and for just being there and being an awesome advocate for consumers. I'm super impressed with you and your group.
Well, thank you, Gary. Again, thanks a lot for letting me be a guest. And if anybody has any questions, just reach out to me. You can even send an email to info@udirectira.com.
All right. Well, Kaaren, I don't see any questions, so I'll pause and hold for a second. But if not, man, direct them to us. We'd love to help you answer questions and help you along on your way. So with that, we will sign off. Thanks so much again, Kaaren.
Thank you.
Bye bye.